Welcome to the daily update, where I'll go over the action in the market for Friday, June 6th, and we'll see how things look for Monday, June 9th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, well, the much anticipated employment report came out, and it wasn't that it was strong, it was better than feared. There was a lot of speculation that it might have came in pretty weak and that the economy could be falling apart, especially from the employment stance. And that didn't seem to happen. Now, one thing that did happen is we're seeing previous numbers continually being revised down, and that is a concern. But the market tends to focus on the here and now numbers, and then at some point they may go back and say, wait a minute, they've been revising these down for a while. Maybe we better freak out about that. So at least not for right now. We are still positive. We're not trending though, and volume is still below average. And we are really dealing with the 6,000 level. The market just is honed in on that. First of all, it's a psychological level, but now it's turned into a technical level. It was acting as resistance on Thursday. It acted as support on Friday. We closed right at it after Friday's session, and it seems to be like a magnet right now. And until we can either break above that and really see some of our indicators start to show some strength, or where we're still positive, but we're not seeing an awful lot of really solid upward momentum currently. Okay, so right at the open, there was positive reaction to the employment report. We had a gap higher above R1, 5986, getting up to that 6,000 level. We did climb above that. We got above 6,000, but we set the intraday high pretty much right after the open, at just a little bit under 6,017, and then we chopped. There was this battle going back and forth, but it wasn't the usual chop where we're just waffling all over the place. We saw a move up, then we saw a move down, then we saw a move up. So prices declined back down to R1, so we found support there, but then we bounced back up to 6,000 again. Then we hit that. It's still acting as resistance within the day, and then declined back down to R1 again. Then we tried to get back up to 6,000, but then we saw some late day fade. It was not necessarily intense late day selling. I mean, we did drop and we closed right down at 6,000, but it wasn't, it was more orderly. And I'll show you the intraday chart here in just a moment. So we were up 1.03%, below average with volume though. There's just not a lot of conviction. You've still got folks that are pretty confused about things, but we're still positive in the short, intermediate, and long term because we're above the 20, 50, and 200 period moving averages. Interest rates, though, that's a bit of a concern, and that might have limited stocks from going up, at least going into the close, because the bond market closes an hour before the stock market, and we're up above that 4.5% level. And that may have induced some of that late day drop off or fade that we saw. And of course, there's all these things flying around. There's the Trump-Musk feud, and that'll be pop news for a day or two. The people that don't like what's going on, they're going to latch onto this and think that they're winning somehow. And the people that do like Trump and Musk and what they're trying to do, they're just like, okay, come on, let's get mom and dad to stop arguing in front of the kids, type of a thing. So it's more or less theater, but what they're talking about is pretty heavy duty with this whole big, beautiful bill. And of course, it goes back and forth on, is that going to be a good thing? Do we have to pass some things that may not be all that great right now in order to have a chance of making things better down the road? Or is this just going to be another one of those games where they increase the spending, they promise to do things that never get done, and then we're in an even worse situation than we are now? If the bill doesn't pass, then the tax cuts that we've been enjoying over the last few years, they're going to go away, and that's going to really hurt the economy. And so the market's trying to figure out, where's it all going to go with all of this? Some comments. The employment report was better than feared and good enough to suggest that the U.S. economy is still growing. Not leaps and bounds, but it is going up as far as growth instead of actually contracting. And the Musk Trump spat continues. I don't pay a lot of attention to that. I kind of wait for things to happen and then see, just kind of take an abbreviated version of it, because you got two really powerful guys who have huge egos, and why can't they just pick up the phone and talk about this in private? Why do they have to do it through social media? And there's even been a few folks out there, I don't know if I agree or disagree with it, that say maybe this is staged for some reason. Maybe this is supposed to be happening. Who knows? It's very complicated nonetheless. All right, then there was an announcement that came out that said the U.S. and China will meet they're going to meet on Monday in London. So there's some continual trade war talks and things that are going to be happening there. Now, if they're going to come to some kind of an agreement or not, who knows? But at least they're going to be talking. We are dropping with the VIX. Now, if we get below about 15 or so, if we keep going up, I'll probably drop this from the bullet point. It's just, I've been including this because the VIX is a lot higher than what we've been used to seeing it over the last few years. And so I tend to hone in on that when we get above the 15 level, especially when we get close to the 20 level. But we are coming down with that. And on a short-term basis, we do have a few things that were on the list, then they dropped off after Thursday. Now they're back on the list again. The Williams percent are showing good positive momentum there, both the CCI 14 and 20. The stochastics has always been on the list. The slope oscillator is still extreme positive, but it's negative. It's declining. It even continued to decline after Friday. And now we're far away from the 20-period moving average again, as measured by the boom indicator. And we still have our momentum oscillators because we've been just chopping around. These momentum oscillators aren't quite sure what to do, so they just kind of float along sideways to slightly declining. There, the PMO is still giving us an extreme positive reading, but just chopping sideways there. And the momentum oscillators, the Arun is still extreme positive, and we're still looking pretty good. Now, these are different indicators. This is the bullish percent index, which is based around the point and figure charts. And that's why I like that. It's a different way of measuring price movement. And we're still looking pretty good with the S&P NASDAQ 100 bullish percent index. That's the large caps. But we're also now back to being far away from the 50-period moving average. All right, no change to the overall Fed. They're kind of in the background right now, but they could come to the foreground at any time. The dollar, actually, it advanced. I should have changed that. That's a mistake here. We did go up, but we're still under 100 with the dollar index, and interest rates were up. As I said, we're at 4.51%. That's where the market starts to get nervous. Interest rates are going up too much, and that's where we saw things kind of fizzle out before. We'll see if that has an impact going into next week, where after Thursday, we were at 4.39%. So the bond market was kind of, at least a little bit, trying to position itself that things were going to be weaker. And that's why we saw interest rates going down. And then when the employment report came out and it was better than folks were expecting, that's why interest rates shot back up. It's like, oh my gosh, we're going to be growing after all. We're not going to be contracting. All right, and we are positive as far as sentiment. We had been at 58 after Thursday. We're at 63 after Friday's session. We're still not trending, though, either in the short or intermediate term. We're below the moving average. We're below 20. But we're positive because the green line is above the red line. And with the up day, the bias is positive. I'm still keeping the momentum at mixed until we see a lot of conviction either one way or the other. Okay, now we did get the non-farm payrolls. They thought it was going to be 130,000. It came out at 139,000, so greater than expected. Hooray, hurrah. Everybody liked that. But the prior number, it was at 147,000. Now, when we saw that number, it was 177,000. They revised it down. So we're seeing some weakness in previous reports. Excuse me. And non-farm private payrolls were also greater than expected. 140,000. They thought it would be 123,000. These numbers were also revised down. Let's see, not very much though, from 147,000 to 100. That might be a mistake there. They published the data a little bit different. I had to input this data myself, so I could have easily had a typo there. The unemployment rate did not change. It's at 4.2%. Average hourly earnings, this could be a little bit inflationary. This might have been why interest rates were going back up 0.4%. They expected it to be up 0.3%. And last time it was at 0.2%. And you annualize that out to a 3.9% year over year growth rate. And the work week stayed the same at 34.3 hours in the average hourly work week there. Consumer credit, it really shot up. It came in greater, 17.9 billion. They expected it to come in at 10.3 billion. Now, last time we had the report, it was a lot lower than expected, where it came out at an increase of consumer credit at 3.4 billion. All right, so here are the earnings, which are still kind of declining a little bit here, kind of flattening out, but still under that 4% level on a year-over-year basis. Then the payroll change, where it was less than what we saw previously, but this previous number was also revised down. And then we look at this with the information that we get on Thursday with jobless claims. That's the red line where we're going up here. We'll be really concerned if we start to get above the 300,000 level, and we're right in the mid 250s or 250 or so now. And if we go above 2 million with the continuing claims, that's where we get concerned there. But the unemployment rate for right now is just staying the same at 4.2%, which is still quite low historically. And consumer credit, which had been coming down, and now it's starting to turn back up. So people are having to use more credit just to live their lives currently. All right, then bull markets last longer than you think. This chart pops up from time to time that Isabel Net blog charts ends up posting here. But we look at the average, it's 67 months. If you go back to when we started, this was in October. Of course, nobody knew that at the time. You can only know this in hindsight. We bottomed in October of 2022. So far, we're 32 months into this. So we're not even quite halfway, according to the average. Now, there are some that last less and there are some that last more, but we just kind of go with an average there. And then the median stock for the S&P 500 is short interest. Now, we're seeing this really going up. Now, that could be negative. It's like a lot more people are starting to short the S&P 500. And so it's like, okay, what do these people know that I don't know? They think we're going down. That's a negative side because this is actually increasing. The positive side is if we do start to go up, all these people have to buy back these shares that they're shorting, and we call that a short cover rally or a short squeeze, and that has some built-in buyers on the sideline. So this could actually be taken as more positive in the bigger picture if we continue to go up. And comparing the probability of a rally with that of a drawdown, okay, this is just some probability here, and we're just about right at the middle with this currently. Then the 52-week market breadth. Now, this is year over year, basically. We look at this every day in the video, and we go day in and day out. But this is getting kind of low when we look at this on a year over year basis. We're getting down to this -1 standard deviation here, which sometimes that could be more negative because we could still drop below the standard deviation level. But this also means that maybe we're getting near some kind of a bottom as well. And then cumulative flows into Bitcoin funds versus gold. You still have Bitcoin being where people really want to be. That's the cool thing. And more money is going into that, even though gold has been performing quite well in 2025. Then the economic surprise index, we were seeing reports coming in stronger than expected. Well, this doesn't count for Friday's employment report. This chart was put out before Friday's open. But this week, we were seeing weaker than expected economic data. And so now that's starting to drop back down below zero. And small caps have been long-term underperformers. Yeah, we're just kind of keeping an eye on that. And if you've been watching the videos that I do for very long, I was talking about in 2022, maybe small caps will look pretty good. Then 2023, maybe small caps will look pretty good. 2024, I mean, it's just been the same story where we have this Santa Claus rally that usually starts in about December and then carries through into the beginning of the new year. and folks were positioning themselves up for that, but then it just kind of fizzled out. This isn't a real good environment for the small caps because we have interest rates going up, and it's really the large caps that have dominated. They can tend to weather things because they don't have to borrow as much money. All right, then here's some charts from a different source here. Revisions are notable and negative. The previous 2 months were revised down by 95,000. This is taking the employment report on Friday and then showing how those numbers have actually been revised down when we get the next reports. And they even go back further than that, but the one that we really pay attention to is just the previous month. There's less momentum in the labor market than initially reported because a month ago, that's what the market was keying off of, was that report and those numbers. And now that we come out with the next report, it's like, okay, were we fooled back then? But the market didn't seem to react to it too much on Friday. So moreover, we should have more confidence in those months since the response rate is substantially higher. That's why we get these revisions. They have to do all their phone calls and emails and figuring out of things so that they meet their deadline to come out with the report. And then a lot of that data still comes in after the report has been released. And that's why we see the revision here. Okay, then, and this is kind of interesting here, where the U.S., and this is like foreign ownership. It's the new international investment position, NIP, with two I's there. It says it also shows vulnerability of U.S. exceptionalism because the U.S. stock market's considered to be the best on the planet. Inflows have been so large into U.S. stocks and bonds that investors, they don't need to do anything more than shave their allocations a little to have a notable impact on U.S. assets. Because we're getting so much investment from other countries, this has helped keep the U.S. stock market more, not elevated, but you could say elevated from a valuation standpoint, but it's helped it to hold up better here. And it shows foreigners own 24 trillion of U.S. assets over what the U.S. owns of foreign assets. So there's a real imbalance there between other countries owning U.S. stocks than the U.S. owning stocks in other countries. Okay, then this is more of a sentiment gauge here. This is looking at institutional sentiment, the State Street Risk Appetite Index. Folks are willing to jump in and take a little bit more risk here. And then this also helps stocks to go up. It's like, hey, I'm going to go in and buy me some stock. I think we're going up now. And so they're more willing to assume that risk, and that helps the actual prices to go up. And then we look at the rest of the world versus the U.S. And I have been talking a little bit about this, where global stocks have been outperforming. This is the ACWI. This is like a global ETF. And then you compare that with the U.S. industry groups and the trends spread between the two. And this is getting really high right now, just showing how at least on this chart, is suggesting that the spread is at a 10-year high compared when you look at U.S. industry groups compared to the rest of the world. The U.S. is starting to, at least according to this, fall back a little bit here. Where the ACWI, it's actually trending higher. That means global stocks are outperforming U.S. stocks. Okay, then economic surprises, strongest in emerging markets. That's not the U.S. We're a developed market here. And then comparing it with the dollar down here. And then the earnings per share revision ratio. And they're actually seeing this going up a little bit in the latest reading as well. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, so here's the intraday chart where we did gap higher. We got up above R1. We got above 6,000. But then we just kind of topped out here, just set it right after the open. So it looked like we were just going to the moon. Well, we didn't get very far off the launch pad, and then we fell back down. Now 6,000 was acting as support, but then we fell down through that. We made it back down. We did hit support at R1, went back up to 6,000, back down to R1. We tried to break above 6,000 again, and then here's the drift or fade that we saw going into the close, and then ended up closing right at the 6,000 level. And things are pretty calm as they're shutting down for the weekend. And they weren't all that. It was a little bit positive here when Europe opened in the pre-market session, and we were actually positive. And then we just added to those gains once the employment report came out. All right, we're still looking good here. Intraday chart, growth versus value. The blue line is still above the red line. And we actually saw growth and value for the large caps about even with each other. So we didn't see much of a breakout there. But when you look at the bigger picture, the S&P growth to value intraday chart is still in an uptrend. Here is the end of day where growth and value were the same for the large caps, up less for the mid caps, up a little bit more for the small caps. So our end of day chart still, we rolled over a little bit here, but looking pretty good with the small cap growth to value ratio end of day chart. Looking pretty good here with the mid caps and improving and just about getting ready to see a golden cross here with S&P growth to value. So this is still holding up, still technically negative until we cross above this here. And actually came down a little bit with this growth to value ratio with these two ETFs. And saw the equal weight discretionary didn't really have all that good of a day. We're actually down a little bit with the staples. So we had been improving, bouncing off the 200-day moving average with the ratio between discretionary and staples. It turned down just a little bit in Friday's session. And here's where we're still not trending. Even in the short term, we're still below the moving average and declining, and we're below 20 with the ADX short-term chart. We're positive because the green line is above the red line. And we're still going down with the intermediate term chart. Below the moving average, below 20, but still positive with the green line above the red line. Dropping off now again with volume, and we continue to be below average that way. And sentiment, we are improving a little bit here with the VIX. We are below that 20 level and declining currently. And the VIX of the VIX, which goes down when the VIX goes down, it's also declining. And kind of just going along sideways now with the momentum of the VIX. We came down. That was the downtrend that we saw. Then we started to go back up, and now we're coming back down. The MACD, which is a momentum oscillator, is pretty much suggesting there is no momentum currently. We went up with this one fear gauge and we went down with the other fear gauge. So we're seeing a little bit of contradiction there. We are seeing a general improvement with the risk on to risk off ratio. When this ratio is going up, the folks are being more risk on. That means they're feeling more positive about the market. And we're improving here with the high beta. These are the Apple, Amazon, Netflix, Google, the big boys that tend to outperform when the market's going up, but they do worse when the market's going down compared with low beta stocks, the more conservative stocks that tend to hold up better when we're declining. And ever since we hit those lows in April, we have been coming up quite strongly with this ratio, even though we've been slowing down lately. The daily chart of the equity put-call ratio now has this going back up. And so we're going back up with the 5-day chart, and we're still declining with the 10-day chart. Not really changing all that much with volatility risk premium. Still just kind of bouncing along the lower end of this band. So no real increase in fear there. Still looking okay, but not setting an all-time high with the advanced decline line based on price. But we are going up here with price and volume. Bigger picture, we're still positive since we're above the advancing moving averages. We did cross back above zero with the advanced decline oscillator. So that's showing some improvement. And we're still above zero with the short and intermediate term advanced decline ratio. And we saw more new highs and virtually no new lows in the S&P. So we're going back up with the 5-day chart and the 10-day chart. So internally, we're seeing things holding up and actually improving. And kind of flattening out here with accumulation distribution after it had been declining. But in the bigger picture, it's still positive since it's above the advancing moving average. And we were going down below. We're just chopping sideways right now with the boom indicator here. We were dropping down below it after Thursday. Now we're coming back above it after Friday. And just pretty much flat right now with the Chaikin money flow. We were going down Now we had the histogram go up a little bit, and so the line really isn't showing a lot of conviction, but we're still declining with the Chaikin oscillator, which is interesting to have an up day like we had and to see this indicator continue to decline. And also interesting here, we're positive with the vortex since the green line's above the red line, but the green line came down on an up day. Now we did decline a little bit with the red line, but it's picking up some weakness here, but we're not all that close to a cross. We're going to have to see some kind of a big move for this to cross over negative. Still holding up all right with the advanced decline lines. We're above the moving averages with all the indexes that we follow. We're above 50 with those stocks in the S&P above their 20-period moving average. That's holding up, but a lot of chop lately as we've been going sideways. Still looking positive with those stocks above their 50-period moving average, 100-period moving average, and we're back above 50 again with those stocks above their 200-day moving average, where we dropped slightly below 50 after Thursday. So just kind of humming along here. This is still fairly constructive looking. We're trying to break out of this range that we've been in, but we're still not trending, even though we've been going up. And so we are seeing, for the most part, a series of higher highs and lower highs. Excuse me, higher highs, higher lows. That's what I was trying to say there. That's a tongue twister sometimes. So this is still looking all right, even though we're not really trending right now, but we're still in a downtrend with the 50 period below the 200. And you can see how volume dropped off. The biggest economic report of the month, and it comes in where the market treats it favorably, and we see a real drop off in volume. That's not really encouraging there. So we came back up with the 20, 50, and 200 period moving averages of the S&P. We're back above the midpoint with the Stochk RSI, where now we're back up showing good momentum according to the Williams percent R, the CCI 14, and the CCI 20. So those are seeing some strength there, but we're not seeing it across the board. The stochastics going back up in the short term, still declining in the intermediate short term, but extreme positive, and flat now with the long short term stochastic, but still extreme positive. And coming back up, it's still below the midpoint with the force index. So it's positive, but it would be more positive if it could get above its midpoint here. We are trying to trudge our way a little bit harder with the short-term trend, but the lines aren't, they're not really going up with any real velocity. They're just kind of chopping up a little bit here. And we're still in the +2 channel with the standard deviations chart. We haven't shown really good strength to kick us up into the +3 channel yet. This is still positive, though. We're above the midpoint, and the midpoint is going up. Intermediate term, this is interesting, too. The balance of power actually declined. Now, we're still positive since we're above zero, but to have the up day that we saw, it's picking up some kind of weakness. So this really dropped off. And we're trying to go back up here with the short-term moving average here after we had been going sideways with our bow tie, but we're above all three of the moving averages. So this is still positive. We're positive with the go, no-go with the darker blue bars. We're still hitting the blue line here, which is the highest high value. That's positive. We're positive on a trending basis with the Landry light and the proper order. TTM squeeze, though, still negative. It continues to decline. Darker blue going down. Hasn't turned red yet, but we look at the context of what's the direction of this going, and that's why we call this negative. And coming right back down to the midpoint here with the ease of movement. It's picking up this sideways chop that we've been in with a real lack of a convicted trend. The Arun, which had been extreme positive, now it's dropping back. And you could still say it's kind of extreme positive. We're seeing a bit of a pickup here with the sellers. And we crossed back above zero with the S&P McClellan oscillator. So now after it's like up day, we're above zero. Down day, we're below zero. We're just chopping all around right now. So now we look at the summation indexes going up, even though it's really hard to see based on price and volume. And we crossed back above zero with the NYSE McClellan oscillator. So that's leaning more positive now. So we're going back up with the summation index based on price and volume for the NYSE. And we were negative after Thursday with the Swindler Trading Oscillator. Now we've turned back up based on price and volume. And here's the PMO. Just kind of, what do I do? What do I do? I'll just kind of float sideways here, but it hasn't crossed below its moving average. But then when we break this out based on price and volume, we are still in downtrends. And crossing back above 50 with the PMOs that are rising, a little bit of a tick up. We got right down to 50 with the buy signals and bounced up to 52 from there and trying to turn back up a little bit with the PMOs that are above zero. We went from neutral to positive with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR, still declining. So this is treated as negative, even though we're extreme. We drop a little bit down below this green line, and I can take that off the extreme positive list. But this is a short-term momentum oscillator that continues to decline. And the MACD is continuing to decline as well, just showing there's really not a lot of momentum. And so it's having a tendency to drift lower. So we're going down with the slope oscillator, flat with the TSI. Those are the two short-term ones. Declining slightly with the MACD, just going sideways with the PMO, declining slightly with the PPO. And we're starting to flatten out and about getting ready to cross below the moving average with the TRIX and KST. We're actually a little bit below it here with the KST, with the long-term oscillators, where we've been negative now for quite some time with the Copic curve. Looking positive, though, with the Sean trend meter. We're in the green area and advancing. We declined with the money flow, but we're still above 50, where we advanced with the ultimate oscillator and above 50. Still above the advancing moving average with on-balance volume. Still positive with the intermediate term RSI and the short-term RSI. The intermediate term trend is still hanging in there. It's been holding up now. We really haven't come down. And anytime we get to this triple exponential moving average, we seem to find some support there. So these lines are continuing to go up. It's more the short term that has been really choppy. And we're above all the plotted moving averages here. That's positive. And we're back to being extreme as far as the boom indicator, as when we measure the distance from price to the 20 period and 50 period moving averages. And we're getting a praying bottom fisher, which, as I pointed out before, sometimes this gives just phenomenal signals. Other times it gives signals that are not very good. So I would not necessarily use this independently. I would use other charts to use confirmation for that. We are looking good, though, with the bullish percent index. We did go up. We're above the green line, so we're extreme, but we're above the moving average. So, and it still has more room that it could go up. And we're going back up with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. And it's also extreme positive. It's above the 70 level. And then we finished out the week. So this is now done. This is a weekly chart of the S&P. We were up 1.5% for the week. And we were able to break out above this previous levels for the last 3 weeks that we've been in. So that's an improvement there longer term. And even on a weekly basis, we were below average with volume. And we're positive with the trend, though. You look at the Heiken Ashi, we have open candles. We're pointing up with the Kegi chart. That's positive. We're positive with the Renko chart. And we're positive with the three-line break. So we're seeing enough upward movement to pick up a positive trend. And we saw one X drawn in here with the point and figure chart, right at the 6,000 level. It's calling this an ascending triple top breakout, which was generated in Friday's session. So that's positive as well. Long term, we're above the midpoint with the 150 and 200 period moving averages. And we're still negative in the long term with the mid caps and the small caps. Everything else is positive. We're negative across the board with bonds based on price, still positive with commodities in the short term, and the dollar is still in a downtrend. All of the sectors ended up being positive. Energy, which has just been getting hammered lately, it did the best. And we had discretionary, which was up, and communication. These are two growth areas. Tech was also up. That's another growth area. Staples were up, but they were up less than discretionary. But everything ended up being positive in Friday's session from a sector basis. So we saw all green here. Canada started the day by setting a new all-time high. We had a BPI cross above 70 with the real estate sector. That's an area that's been getting hammered lately. And then the NASDAQ went above 19.3, 19.4, 19.5. The S&P got above 6,000 and it closed right about at that level there. And we see it mostly green here with the market carpet. This is just for Friday's session. So it was really the mega caps that helped keep the index together over here. Microsoft, Nvidia, Apple, we had Google, Meta. They were all up. Amazon, Tesla ended up bouncing after falling, what was that, 14% on Thursday? Not a good day. So it got about 3.5% of that back. And we're still above the 200-day moving average with the Dow. So that's holding up longer term support there. We are positive with the Elder's Impulse system for the diamonds and looking okay here with the NASDAQ. Not showing an awful lot of conviction, but it has been looking good lately, even though it's still in a downtrend. But we are positive with the Elder's Impulse system for the NASDAQ. Looking okay here with the NASDAQ 100, even though we're still in a downtrend. And we've gone from neutral to positive with the Elder's Impulse system for the Qs. But the momentum, because we've been just chopping around all that much, kind of going a little bit higher, coming back, going a little bit higher. The PPO is still showing us it's extreme positive, but it's dropping below its moving average. So it shows more of a negative momentum for the NASDAQ 100. And small caps ended up being up, but they still haven't come back to these previous highs that we've set here. And we did see an improvement with the other with the other small cap index that we look at, the Russell 2000, coming back up with RSI, getting close to that 70 level, still above the 50, but below the 200. That's why it's negative longer term. If it crosses above the 200-day moving average, that would turn the long-term trend for small caps to positive. But we are turning back up with the MACD, and this is measuring the shorter-term momentum. And we're positive with the Elder's Impulse system for the small caps, kind of chopping along sideways here with the mid caps, but they are positive with the Elder's Impulse system. And with the broad market measure, the Wilshire 5000, we are showing some improvement here, up over 1%. We were also up with the total U.S. stock ETF. Financial sector was up as well, still holding up fairly well there. FANG index setting another new all-time closing high, actually set an intraday high as well. These are the really big stocks. This is what's starting to drive the market, at least lately, and keeping it holding up for right now. And we did just see a recent golden cross right at the beginning of June. Apple was up 1.64%, but still in a downtrend. Amazon was up 2.72%, still in a downtrend. Microsoft just about getting ready to generate a golden cross here and up and doing quite well these days. Google in a downtrend, back above its 200-day moving average, up 3.25%. Meta was up 1.91%, still in a downtrend. We might see a golden cross here soon. Nvidia was up 1.24%, above both the moving averages. And Tesla, after dropping down severely on Thursday, was able to gain 3.67% of that back in Friday's session. Netflix actually gave a little bit back after setting a series of new all-time highs. And still looking a little bit stronger here with the short-term correlation between U.S. and world stocks, where it's starting to level off. Longer term, it's continuing to show the correlation getting stronger. Coming back up into more the mid-level now with oil in 64.77. Still in a downtrend with the dollar, still below 100, even though it was up. And as far as Truflation's take on inflation, they're still coming in under that 2% level at 1.84%. Now, this is not a government agency or anything. This is a private company that does this. So that's why I look at it. I want to know what it is, but I don't necessarily make decisions based on this. Where the market does base decisions on government reports, as manipulated and as inaccurate as they may be, that's what the market does use. Okay, and we're back above 4.5% now with the 10-year yield. So I should have changed that there. We're actually above 4.5%. And we declined here with the 10-year based on price. And we are still looking okay with our growth to value ratios, except for discretionary to the S&P. It's falling down here, where the Qs to S&P, it dropped back, but it's still above an advancing moving average, and we're still above the moving average when we look at large cap growth to value. So the large caps, mid caps, and even small caps are above their moving averages. So what's the outlook then for Monday? We're still positive. I haven't changed this. There's been really no need to change this. We're positive in the short, intermediate, and long term, but we're not trending. And I should have updated this as well. So I will show you the calendar here in just a moment. And then anything that may be announced over the weekend, either good or bad, could produce some kind of a gap up, gap down. That might have been why some folks were doing some hedging ahead of the weekend with the equity put call ratio, because it's very frustrating to get caught with that when the market can't react until Monday morning. Okay, here is what we're looking at for Monday. Wholesale inventories, not a major report. We're not going to have any on Tuesday. Then we're going to get big one, the second biggest report of the month. CPI will come out on Wednesday. Then we're going to get jobless claims and PPI on Thursday, and then consumer sentiment. This kind of comes and goes as far as how important it is with consumer sentiment. But right now, it's people are real emotional. And so if they're feeling better, that's having more of an impact on the market. If they're feeling worse, that's also impacting the market. Okay, and then here is the calendar for the upcoming week. Seasonality, though, we're positive with the Dow and S&P for June 9th, where we're neutral to positive with the NASDAQ. But when you look at post-election years, according to the Stock Traders Almanac, we see a few days here of some weak seasonality. This will go through Monday, Tuesday, and into Wednesday before we see a little bit of a bounce going into Thursday. Again, doesn't mean that's what's going to happen. This is just what has typically happened during post-election years. And here are the pivot points for Monday's session, updated on the YouTube community tab. With each video in course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. All right, I'm still keeping the smart money indicators on the negative side now, even though we're positive with accumulation distribution. We're above the moving average, but we're just kind of chopping above and below the moving average when we look at the boom indicator. We're flat with the Chaikin money flow, where we're still negative with the Chaikin oscillator. So a mixed picture there. And then our longer term trends of the growth to value and discretionary to staples ratios, they're still negative for the time being, but they're both above their moving averages. And the Kopit curve is negative, and the long-term special K oscillator, which I'll show over the weekend in the weekly videos. And then the momentum for the NASDAQ 100 is also negative. Then positive, we have the bullish percent indexes, and that's rather encouraging that they are looking good, especially for the S&P and NASDAQ 100. We're backed on the positive side with the McClellan oscillators and summation indexes for the S&P and NYSE. The Swindlen trading oscillators now going back up, as is the parabolic SAR. And this is another mistake here. I thought I went through and checked this. We're above 50 with all of our moving average studies. And the S&P oscillators, yeah, they're positive, but they're just kind of drifting sideways. And some of them are actually starting to decline. We're positive with the ease of movement, the money flow, the ultimate oscillator, the vortex, the financial sector is looking good. And we do have that Pring bottom Fisher buy signal that has been generated. All right, so no change now to the overall conclusion. We're positive, but we're not trending. So we need to see more of a conviction to the upside to really get us back into a trending environment, even though we are positive. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.